On today's show, 3 questions. Number 1, does uncertainty mean lack of clarity? Number 2, is your debt making you unhappy? And number 3, are we seeing the death of reading?
Consult an advisor or conduct your own due diligence when making financial decisions. General principles discussed during this program do not constitute personal advice. This program is furnished by Dentist Advisors, a registered investment advisor.
Welcome to Dentist Money's 2 cents, where we help dentists navigate all the noise. I'm Matt.
And I'm Rabih.
Yeah, you are. What's up, Rabih? How you feeling?
I'm doing great. How are you?
I'm doing great. I don't know what to think of this. Notice I said think. Right as we were getting ready to start, Justin came in my office and he was like, "Hey, you should eat this." And it's a protein bar called Think. And I was like, "Thank you. Is this some type of subliminal message that it's like giving me a smart water?" It's like, what are you trying to say?
Yeah, it's when you gift someone perfume.
Yeah. They're like deodorant. You should try this deodorant. Anyway, I'm excited. This show is not brought to you by this protein bar, but it is Think High Protein Girl Scout Thin Mint. So I'm excited to give it a shot. My favorite protein bars right now, let's bro out for a second. My favorite protein bar right now, have you had the barbells, Rabih?
No.
Oh my gosh, they are like candy bars.
Okay.
They're so good. I'm like, these can't be healthy, but they're perfect for road tripping because I'm a snacker on a road trip. And so it's good. It's great for me because I love to snack when I'm driving on a road trip. So I get barbells because they taste like a candy bar.
And it has lots of sugar in it?
No, it doesn't. But it's got to have something like chemicals.
Yeah.
It's either sugars or chemicals. You got to pick your poison. But either way, we digress. Thank you for letting us do a bro minute there. Jim Bro moment. All right. This show is brought to you by Dentist Advisors. We are dental-specific financial planning, investment management, and accounting firm just for dentists. Our sole focus is on helping dentists make work optional sooner. So if you're listening to this show and you're that person that's like, I talked to a guy the other day, Rabih, that's like, I listened to you guys for 5 years. I finally decided to call, and I'm glad I did. I'm like, there's more out there. If you are sitting there thinking, should I call these guys? The answer is yes. Go to dentistadvisors.com, click on the book free consultation button. We are super nice. Rabih, how nice are we?
We're waiting by the phone to pick up.
We're waiting by the phone. No, we honestly would love to talk to you. We talk to hundreds of dentists all over the country every year, and we are here to help. So give us a call. Okay, jumping in, Rabih, what does uncertainty mean lack of clarity? What do you mean by that, Rabih? Tell us more.
Dude, I don't mean anything by that. But on Wednesday, the chairman of the Federal Reserve, the new chairman of the Federal Reserve, Kevin Warsh, had his second meeting. And the Federal Reserve decided to keep rates at the current level. And the vote was 9 versus 3 to keep it, 3 to hike it. And then he went on to this press conference and he literally said, the current uncertainty does not mean there's a lack of clarity around interest rates. He said that. And I kind of disagree because, dude, you eliminated forward guidance and everyone's confused. This is what's happening.
Yeah, that doesn't really make much sense. I don't understand that.
Well, I can find an argument for it when it's like, oh, the markets is all over the world and it's like all over the place and investors are panicking, etc. But we tell people the fact that life is uncertain out there does not mean that we should not have clarity on our goals, which is stick to the plan, invest for the long run, etc. And I think this is what he is saying. It's like the uncertainty with the oil prices and inflation numbers, because now they're not data dependent, right? And all the data points that are uncertain that are coming out for our way should not deviate us away from the clarity that we want inflation at 2%. Like this is the only thing he wants to stick his neck out on. We want inflation on 2%, but unfortunately, he's not doing anything. He in his first meeting, he kicked down the can and said, "Oh, I'm making some task forces to deal with this." And today he's saying, "I'm going to be meeting with the task forces and I'm going to say something about it in the Jackson Hole Symposium in August." Like he's been kicking the can down the road, and nothing is happening. Let me tell you what he is saying. He is saying is that since the last meeting, both real and nominal rates are higher and they are in the top decile in terms of their movement. And, you know, coincidentally, we just talked about this last week. We said like interest rates are going up so high. The 10-year yield is now 4.73. Whenever the 10-year starts getting near the 5% level, markets absolutely do not like it. and the 30-year interest rate is in the 5.3 range. And this is as high as it was in 2007 pre-crash. So since nothing has happened from a monetary policy perspective between the two meetings, but the bond market is just moved the rates higher. They moved the rates significantly higher since then. And according to Kevin Warsh, this is happening is because the market has reacted to the data like it's supposed to, instead of it's waiting for us to tell it the path and show the forward guidance. And he literally, I don't know why he was sassy on that meeting, but he literally said, market participants are learning to play ball, not be the referee. So like he literally said that on the press conference.
I just love that you said the word sassy. That's what I call my 7-year-old daughter all the time. She's always being so sassy.
Well, this is his second meeting, so he's still very young in the meeting thing. So I'm going to call him sassy. And I'm like, okay, this new Fed is saying that we do not want to hold the hand of the market. Instead of setting expectations for the market and telling it what we expect to do by communicating what they've been calling the reaction function. How would we react if inflation goes up? How would we react if jobs become off balance, etc.? We are not going to do anything. We're not going to make any signal. And then the market will take in the data that's coming from the economic news, data points, surveys, etc. The market will react. And then we will say, well, the market has reacted that much. This is a signal for us. So they want the market to kind of guide the Fed versus the opposite. So what he was saying is, interest rates have went up across the board. And this is because GDP is at a normal growth level. Unemployment is steady where it is. There's a slight inflation. We are in a cusp of big investments in AI. The economy is growing and there's a little bit inflation. This is very healthy. The bond market is pricing that in. So in a sense, anyone who's saying, whoa, why didn't you increase interest rates? Oil is back up in the 100, inflation is coming back, etc. It's like the market already took in the information and is doing the work. Why would we want to raise interest rates? Which is a very annoying Fed to deal with. I'm just going to vent out for a second.
Please, vent.
It's just a very annoying Fed, because now you're going to take what is happening in the market and either ascribe it as something that you wanted to happen in the first place, or just then you come and intervene. And this is my own opinion, if we go back a year or two ago on 2 cents, if you listen to it, there were so many episodes.
Which everyone does, obviously. Everyone goes back and
yeah, don't you go through the archive on a weekly basis?
Exactly. You should be.
So there were so many episodes where we would say, remember August 2024 and in the beginning of 2023, right after they stopped cutting interest rates. There were a lot of times when the market would move in a different way and the Fed would say in the summary of economic projections that this is what they expect inflation to be or unemployment to be. And there were so many times on this podcast where we said, the market has an opinion and the Fed has an opinion, and only time will tell which one is right. Right. And it happened across the board. Like, if we go back to the inflation episode of 2022, the market started showing high inflation, interest rates started going up, stocks started falling before the Federal Reserve started increasing interest rates in 2022. Right. And we said, the Fed was late. The market was correct on that one. There was an episode where that was the conversation. And then there was a different conversation when the Fed was saying, we're going to have a soft landing. We're going to be increasing interest rates and holding them steady, but it's going to be the first time we're not going to trigger the economy into a recession after an inflationary pressure. And the market did not believe that. Remember, we had the yield curve inverted for over 2 years, and the yield curve uninverted, and a recession did not happen. So there are always times in the market when the Fed has an opinion, the market has an opinion. Sometimes one is correct, but only time will tell. But now this new regime is saying we have a market that has an opinion. We're going to look at the market's opinion, but us as a Fed, we're not going to give out an opinion. We do not want to stick our neck out. And his argument was forward guidance during crises provides clarity and is prudent. I'm like quoting him. But in benign condition, it ties our hands behind our back. So there's this new guy that has come in. He came in with, a big agenda of reducing the balance sheet and making interest rates lower. And then now when he's in office, we're still in the same balance sheet environment. He's now saying, oh, ample reserves, aka big balance sheet, is good, and now he shifted it to interest rates, but he's not doing anything about interest rates. Thankfully, Matt, my frustration was also portrayed by others in the meeting, and other people of the press in that room were pushing him, and he literally said, I know that households and businesses think that the Fed are being impatient with the Fed. They want us to deliver it already. Like, this is what he said. So, but we're not under any obligation to deliver it already. We have a task force that's working, etc. So, in summary, it seems like the Fed hasn't done anything and is kicking down the can. I do not know how long that will last before the market flips on him. That's my opinion. And what do we mean? What do I mean by it flipping on him? 10-year interest rates are now 7.3%. By the time they hit 5, and if we look at, like, I'm not predicting, but there's a pattern. When they go up, market usually corrects 10 to 15%. That will happen. The president will start tweeting against him, although he just assigned him. They have to do something. They don't want to stick their neck out, except saying we want inflation at 2% and we're committed to that. So they don't put themselves in a corner. But the longer they stay without giving the market the confidence that it needs, the longer they put themselves in that corner of, dude, why are you not doing? So we won't have a decision from the Federal Reserve until September, end of September, because in August they meet in Jackson Hole, Wyoming, but it's just a press conference. There's no decision. They do not vote. So it won't be until kind of towards the end of Q3 until we get news from the Federal Reserve. Currently, for the September 16 meeting, like, that's when they're going to be meeting again in 46 days, there's a 68% chance from the market that they hike. So if September comes and they kick the can down the road again and the market's saying 68% you should hike, we're signaling it through prices. It'll be interesting.
Rabih.
He's my new partner and we're having communication issues. This is
a problem. Methinks there's some trouble here with the Fed Love Island that you have going on. There's some issues here. He's not communicating very well, and we don't like it. The key to every good relationship, Rabih, is communication. Does he not know this? Does he not know this?
And he's like, there's no forward guidance anymore. I have a feeling that the Fed is doing 85% politics and 15% policy, which is why.
This is my take, or this is my question, not my take. I have no idea. My question is, how much of this is placating and feeling the pressure of the politics of it and of Trump specifically? And because it feels like his tone has changed before he came in, around, like, him being really staunch on this idea of, like, we are an independent body, we're separate, everything's going to kind of stay independent. And now it feels like a little bit more wishy-washy and feeling maybe a little bit more pressure from Trump in politics. What are your thoughts?
It could be that he's, between a rock and a hard, what's that English saying?
Rock and a hard place.
A rock and a hard place, because if it wasn't for an oil shock that's happening from geopolitical tension, inflation was trending down, especially core. Like, it was trending down. And he could have came in and probably said, we're cutting interest rates and at the same time reducing the balance sheet, and his initial plan would work. But suddenly the macroeconomic regime completely shifted after April, after the war started. And now we have here's the thing, we've been having consecutive small shocks. And yes, they sum up, and we're in a position where we're seeing inflation creep back up again. And now maybe the prudent thing to do, if you really want to do monetary policy, is to pivot. But because he came on under a very certain color, he does not want to pivot and break away from that color immediately. I really do not know how they're going to get out of that hole that they're digging for themselves by just saying, do not look at us, do not look at us. And
it's like my son. He gets embarrassed easily. Don't look at me. Yeah, that's tough. Where's Jay Powell in all this? He's still hanging on the committee?
He's still hanging on the committee to protect himself legally.
Yeah.
And he has voted in both meetings, and his vote has been to keep rates steady, last meeting and this meeting. So this meeting, the 3 dissenters who said they want to increase interest rates are not like Powell. It's some other people on the committee. to get interest rates high.
Okay, so do we have clarity then? We don't have clarity. We don't know.
I
what's
don't
going
know,
on.
but uncertainty does not mean lack of clarity, according to him. But
Okay.
I can't sleep at night.
Rabih just wants that new car smell. Come on.
Yes. Yes.
I think the problem is we had J Powell listening to 2 cents by the end of his tenure, and I don't know if Warsh is yet, but that's maybe the issue.
We should send him a link, right?
We should write a letter. I'm gonna message him on Facebook, see what he says. Okay. Anything else on interest rate confusion?
No, but to be continued. If the long-term interest rates, especially the 10-year, keep creeping up, this is going to become on the news again.
Yeah.
Yeah.
And we will be covering it here.
We will be covering
it. Okay. Is your debt making you unhappy? So this is a big topic, Rabih, because we have some strong opinions around, obviously, working with dentists, debt load and dentistry kind of go hand in hand. And our thought, just to I guess start with this, is and continues to be, and I don't know if we're going to get into kind of the nuance here, but our take has always been anecdotally and through our experience with dentists that there's less of a connection between debt and emotional well-being. There's less of that connection versus liquidity and emotional well-being. So meaning most people talk about debt being their stress when we say yes, but that's only secondary to not having enough cash or not having enough liquidity. So if you have dentist A with $500,000 in debt and no cash versus dentist B with $500,000 in debt and $100,000 in the bank, our take is dentist B is far less anxious, even though they have the same debt load. That's our take. And so that's why this is a really critical topic, because there's a study that, Rabih, you brought to the group. This came out. You called it a famous study, by the way.
It is.
Is it famous?
Yeah, like the citations on it are a couple thousands. It is
okay.
Famous study.
It's famous because I said famous on a podcast the other day about talking about some study in psychology, and I was like, yeah, this is a famous study, and then I was like, maybe only for nerds. I don't know if it's like there's context around the word famous.
Yeah, it's relative. It's famous to its community, to the academic community.
Yes, got
famous
it.
for the academic community.
For the nerds. Got it. Perfect.
Okay.
Okay. So this consumer debt and life satisfaction study came out in 2020. And the big questions it's asking is, does carrying debt make people less happy? And by the way, if anyone's watching on YouTube, I've got too much going on my screens with all the different things we're talking about today. So I busted out the other screen today. Okay. So this breaks down, does carrying debt make people less happy? So this starts out 80% of Americans carry some form of debt. So this was in 2019, U.S. households owed a combined $13.86 trillion. That's roughly $100,000 per household. Yet most happiness research focuses on income, largely ignoring debt. This study dove more into the debt piece of it. Before we go any further, let's give an update of where we're at on debt loads, because this was from 2019.
Yes.
So Rabih also shared this. Rabih, you're just carrying the show as always. Shared the data here around overall household debt has been on the rise from 2004. Peaked into the 2008, came down a little bit, and now has climbed the mountain again. So we are now at total debt, household and non-household debt, about what was that showing? About 18.5 million, Rabih?
18.5 trillion.
Sorry, trillion. Yeah, million. Yeah. Not your investment portfolio.
This is just a rounding error.
I had your investment portfolio up next to it. I was getting confused. So I was helping Rabih out with some investment stuff. So $18.5 trillion for household and non-household debt. So just for context, this report came out in 2020. It said in 2019, we were at 13.86 trillion. We are now, this is Q1 of 2026. So 7 years later, we are now at 18.5 trillion. What say ye just about that, Rabih? Just the overall number climbing that much?
It has picked up, like the growth usually over a 6-year period. This is one of the faster ones compared to previous 6-year holding periods. But something else we have to keep in mind is that like the economy, like the stock market, debt grows with a growth rate. It does not grow at the same period. So just like with a stock market, the first 100,000 is so hard to reach, and then the last 100,000 before reaching 1 million immediately happens because we're growing at the same rate. The same thing with debt happens. The first trillion of debt are so hard to accumulate, and then the next 5 are much easier.
Yeah.
So that contributes to it.
It's compounding, right? Compounding is simply a tool. It can work for you or against you.
Yes.
So totally right. So this breaks down 13.64 trillion is in housing debt, and then 5.16 trillion is in non-housing debt. How that is broken down, I thought this was intriguing, and people might want to know how this is broken down in the non-housing debt section. 1.66 trillion in student loans. Other, I don't know what we would categorize as other outside of these, Rabih. I don't know if you know that. Maybe these are like high interest shark loans type of thing.
Probably, yes.
So $500 billion in an other category. Credit card debt is 1.25 trillion, and then auto loans at just under 1.7 trillion.
Other balances include retail cards and consumer finance loans. So think of the buy now, pay later.
Pay later. Got it. This was interesting and a little bit scary, we'll call it, as we're talking about debt. Before we jump into the study in detail, delinquencies are also on the rise pretty much across the board. Credit cards have jumped, by like double, Rabih, from 2022 Q1 to Q1 of 2026. Over 4 years, we've doubled basically from about 7.2 to not full double, but close, over 13% now on credit card delinquencies, 90-day plus delinquent. We've creeped up on the other category as well, almost to 10% delinquencies. Student loans, here's my question. Student loan delinquency, so 90-day delinquent. This just means a payment has not been made on a balance due.
For 90
right?
days.
For 90 days. Student loans have skyrocketed. This isn't that shocking. It went from basically zero because we were in forbearance for years and people just shut down their student loans, basically. We're now up over 10% on delinquencies. I wonder how much of that, Rabih, is people that have just forgotten about their student loans and not realizing payments are due.
Or the website is not helping them, right?
Yeah. I just wonder if there's a lot of we just got lulled to sleep on the student loan front because there's been so much chaos and administrative forbearance, and now they've turned back on and people haven't really realized it. Auto loans stayed pretty steady. We're at 5.6% on auto loan delinquencies. Scary data, I'd say overall, a little bit disheartening here with some of these figures. You have thoughts on this?
I think the fact that our total debt balance, 13 trillion is in housing and 5 trillion is non-housing, we're seeing cracks in the 5 trillion portion. As long as we don't see cracks in the 18 trillion portion, we're completely fine, right? And if you look at the chart, that orange line, Matt, that is the delinquency on mortgages. So in Q1 2010, that's the peak of mortgage delinquencies. 8.9% of all mortgages were delinquent. Now we're still at the 1% level. So I think we're still fine. I know it's a lot of debt and it's going up really quickly, especially credit card. But given that credit cards are not the biggest portion of our net worth as a consumer base, I don't think that will impact spending, and then that would not impact GDP and put us in a recession.
Yeah, you also just called me out unknowingly that I should have been sharing my screen this entire time, because this is how new we are to YouTube. I'm not even sharing my screen showing all these data points, so apologies. But yeah, that's a good point. We're below 1% still on delinquencies for homes. So, that's basically it's like, if you look at the chart, it's down a cliff basically from 08, 09 down to now. It's like we basically have no delinquencies on homes, which is not a shock because of how stringent we are now on buying homes, being being qualified for a home. I think that's a direct result of that.
Oh, yes. I'm just going to add a note over here. These structural changes that we see in these historical graphs are not a result of people changing behavior. This is literally the result of laws and regulation. We see the same thing with banks and the risk banks take. Now you look at the charts for our banking sector and it's risk assets are within very healthy norms. So it's really with markets abuse any opportunity for efficiency and to make money, and then nothing fixes it until regulation is put there. Markets just feed on themselves. So and that's why crashes do not repeat themselves. If you do not institute new laws and regulation after a big crash, like the dot-com bubble regarding IPOs, or the Sarbanes-Oxley Act and the Basel III Accord after 2008, or I do not know what main regulation we did after COVID, right? Because that was not economic in a sense. But we did introduce currency sweeps with other currencies to make sure that no currency defaults or devalues during that time. Now these are problems of the past. It's going to be very weird to see an exact 2008 type of crash where the mortgage-backed security quality is so low that it trickles down into the economy, because the law now does not allow it. So the next crash is going to be in stuff we haven't properly regulated correctly. Hint, hint, AI.
And we're cough, hint, cough, AI. Yeah, it's a great point, Rabih. A proper side quest there, that the shock that creates the crash is often different, maybe all driven by the same fundamental human fears or greed or emotions, but the details are always different. So to your point, I love that. That's a really good distinction there, that we respond. And it makes me think of the Carl Richards quote: "The only risk that matters is when you think you've thought of everything else, or are the ones that are left after you think you've thought of everything else." Right. So we only can prepare for the risks that we've actually seen. The ones that we don't, that's what's going to cause. I love that you brought that up, and you're calling your shot. You're saying it's AI. We get it. Okay, you heard it here first. It's going to be AI. Okay, so the rest of the study. So what it did was they took 7 studies across 5,800 diverse American adults, examining the relationship between 3 common debt types and self-reported life satisfaction. There in and of itself is a little bit tough. Whenever we have self-reported, that's kind of one of the limitations of things like this. Just to call that out. But they had 3. So mortgages, credit cards, and student loans. So mortgages, obviously the largest debt balance people carry for the most part. Credit card balance is the highest interest rate, and then student loans being the growing burden, especially for Gen Z and millennials. They called this a surprising finding, and I'm not totally sure that we'd say this is surprising. But I want to hear your thoughts. Their finding was that the debt that caused the most negative relationship was student loans. So student loans had the strongest negative relationship between life satisfaction, more than mortgages and credit cards. That doesn't shock me too much. Rabih, what do you think?
I don't know. I did not have a student loan in my education journey, so I could not reflect because it's self-reported. So it's like, how do I feel, right? But when I have some credit card debt or an auto loan, it bothers me. I'm a guy who, I don't mind margin on my account, but it really does bother me with the credit card. And here's what I think of it, and I think this is what the study kind of leads to at the end, and I agree with them, is that you took out the loan. Did that money just disappear on something, or are you actually seeing it paying you back? You, like in a mortgage, you're putting that money in the house, and like that house is becoming yours. And a car, although it's depreciating, the car is becoming yours.
You're
right?
driving it actively, yeah.
And a credit card, you're giving yourself room to buy more stuff again, right?
Yeah.
But with a student loan, once you do it, the idea is you go to college, you get a student loan, and that gives you a better career, right? But between taking out the loan and getting a really good paycheck, there are so many steps in between that could go wrong. The quality of your education, the quality of, or the status quo of the labor market when you're trying to get into a job, how bad is your manager, and how good are your room for internal growth and promotions in the company? All of these have to line up in your favor until you reap that reward of a higher paycheck. So because there's a big gap, and it always doesn't, will not always lead to B, people will feel like, oh, I just burnt the money.
Yep. Totally agree. That's where it doesn't surprise me. Like, they call this a surprising result. Again, our bias is we only work with dentists. So I just hear from so many dentists how much their student loans bother them. And the theory is exactly what you said. Student loans are paid off after the benefit, or in this case, the education is consumed. So it's a mismatch of payment versus actually enjoying the benefit from a timeline perspective. You're paying for something you're no longer actively receiving, just like you said. A mortgage, by contrast, is paid while you're living in the home. Consumption and payment are aligned. This mismatch makes student loans feel burdensome in a way other debts don't. Credit cards fit that. It's just on a shorter timeline. I also think there's an aspect of, let's imagine you put a trip somewhere. You went on a big, huge European trip or something on a credit card. The memory dividend off that is way different than what you get from student loans. So I guess my overall takeaway here is I'm not shocked by this. It doesn't. I like that student loans feel more burdensome than other debts for dentists. I would argue that a credit card balance that you're carrying forward month after month, if that is you, that should bug you more than anything, because that's going to be triple the interest rate and destroy you way faster than a student loan balance will. So. But again, I'm not surprised by this, and I still have a firm belief that liquidity, above all else, above income and above debt, is more of a link to your well-being than any of those.
Yeah. There's one last part of that study that I found very interesting, is that once they sat with people and they told them, or kind of behaviorally trained them, to stop looking at student loans as if they're a credit card loan and more like a mortgage loan, aka it's more of an investment that you're doing in yourself and that you're going to reap the rewards. The more you shift that focus and try to find value in the investment virtue of your student loan, the less stressful it's going to be to you and how you perceive it, which is true. I think that works for dentists a lot, because dentists are a really successful career path. The quality of the student loans in dentistry are much better than in, arts degrees, right?
Yeah.
Especially when it comes to your ability to find a job and make a good earning afterwards. So I think it's much easier for a dentist with a lot of student loans to tell them, hey, if you shift your perspective slightly from thinking about student loans as just any other type of loan that is daunting and think of it as an investment, the burden is much less on you in terms of the stress. Whereas for non-dentists, it's a much harder conversation.
Yeah, it's very true. And it's a good point. It's like we talk, like in this study, and the theory is that they're saying you're no longer actively receiving the benefit. So they're saying a mortgage, you're living in the home, so the consumption and payment are aligned. Sure, but I would, to your point, you are actively receiving the benefit of your student loans. You're in your career. The only reason you're there for 90% of dentists, plus 95% of dentists, the only reason that you have the career that you're building and the practice you're working in or the practice you just purchased, whatever, is because of the student loans. So you are actively engaged in that. It just doesn't feel like it because you spent it before. So I think that's a great point, Rabih. The mindset shift of this investment, not some like weight around your neck pulling you down. So, and that doesn't mean we're not saying you should just kick the can down the road and never address them, but just looking at it in context, I think, is important. So it's a good point, Rabih. Anything else you want to add to this?
I don't know if I want to open that can of worms, but you'll answer how much you want to answer. But in this situation, when there's the psychology telling you something, but the spreadsheet's answer is telling you something else, which path would you do? And I think the answer depends if you're doing it alone or not, if you have a financial advisor, right? But if there are two answers, there's a psychological one and tells you, hey, student loans are burdensome, more burdensome. Would you go and recommend paying the student loans? Or would you recommend not to pay them or like immediately pay them down like we do here at DA? So spreadsheet answer, not spreadsheet answer. How do you address that?
Yeah, I've had clients who have gone against the spreadsheet answer and gone really aggressive with their student loans, even though it did not make sense for their overall wealth, right? Like there was a better option for sure. I guess I'm not here to tell anybody there is one right answer or the other. There's, again, to your point, there's a spreadsheet answer that we can figure out. The math part of it's not that hard to figure out from a probability of success standpoint, which is going to be the best. Like there's certain variables we can never know. Just ask Kevin Warsh, uncertainty versus clarity. There's certain variables we can never account for, but the spreadsheet probability of success type answer, we can solve that. The problem is we are not all rational actors and we don't live in a spreadsheet. So that's what makes every answer we ever have on stuff like this is it depends. This is why we always say, shout out Taylor Sutterfield, general advice is really bad specific advice, because there's human emotions and our stories and our experiences and our psychological benefit, all the psychological aspects. So there's not like one right answer in my mind. What is your take?
I'm more of a spreadsheet guy.
Yeah.
I swallow the emotions and try to do the spreadsheet.
Yes.
Personally.
I totally, yes, that is but I think you receive psychological, like you kind of blend the two, meaning I think what your personality is, if it makes sense on the spreadsheet, I'm good. That's my emotional blanket.
Yes.
Where not everyone has that. So it's just knowing your personality is critical. And this comes back to like what our job is. We talk about this as a team all the time. Like, what is our job? To us, our job is to educate as much as we possibly can, help clients understand, help dentists understand this is all a game of trade-offs. There's very, very rarely a black and white, this is always the right answer. It's just, hey, if you go this route, here's the thing you're giving up. Here's the trade-off that you're making. And if you go this route, here's the corresponding trade-off. And kind of empowering them with that. And then, yeah, of course, guiding them, but not saying like, hey, this is the right answer. You're wrong if you don't do it this way. That's where I think people get in trouble. So, and bottom line is the only strategy that matters is the one you can stick with. So that's a really critical piece of this. If you could have the perfect strategy, and if you bail out of it at the first sign of trouble, it meant nothing. So adherence is more important than anything. So anything else on this, Rabih?
No one can top that.
Oh,
a bucket of wisdom just
perfect.
over my head.
There it is. Okay, this is just a fun one. We'll end with this. We'll be short. If you have a chance, go listen to Derek Thompson's last episode with what is her name? I have her article right here. Rose Horowitz. It's fantastic. So she wrote an article for The Atlantic called "The End of Reading Is Here," and Derek Thompson had her on his podcast talking about this. And this was just more of like a personal thing for me, Rabih, and I know for you, because I know you're an avid reader. I don't know if you want to share, like, if you even know like how many books you read a year, but you're an avid reader. It's I don't want to put words in your mouth, but it's one of your top hobbies, correct?
I read a lot. I do not read fiction. This is the thing about me.
Yeah.
So, like, my entertainment is like that study about happiness, 22 pages in fine print. Like, I read that for leisure, right? Yeah. Instead of just reading fiction.
Yeah, so, you're... Don't take this the wrong way, but you're a psycho, but we all love you. Like, yeah, most people don't read studies for fun. But I'm with you. I'm the same way. I'm like a total nonfiction nerd. I think it's part of maybe my lack of, like, I just need you to spoon feed it to me. And I fully acknowledge that. Like, I want you to tell me, like, I love like Atomic Habits, right? I love a practical book that's like, help me improve my life type of thing. However, it's interesting. I've been thinking about this a lot lately anyway, but when I read this article, and I highly recommend everyone read it. It's long, and the podcast is a kind of a shortened version of it. But when I read this, I was already thinking about this, and this has really inspired me even more to actually dive in and read more nonfiction and read more of the classics, the classic literature. And this article talks about why. But so let me just jump into this. There's some disheartening figures here. So fewer than half of all adults reported having read a book of any kind in 2022. Less than half. A book, not a book of any kind. Does that shock you? Less than 50% of Americans.
As of 2026, in the age of TikTok?
Yeah, it's probably less now. The last data that they have on this was 2022. Yeah. So that in 2022, it was fewer than half of adults. Now it's probably even worse. So not shocking to you?
No.
Yeah, probably not. Only 38% read a novel or short story. A study analyzing 236,000 responses to the American Time Use Survey found that a proportion of Americans who read for pleasure on any given day fell from 28% in 2004 to 16% in 2023. And I would dare say, if you redid that, it's even lower. It's even less than that now with the rise of things like TikTok, to your point. What's they compared this to, so gambling has now become a more common leisure activity than reading a book. Last year alone, nearly 60% of Americans placed a bet. So you're more likely now to gamble than to read a book.
This is where the problem is. Like, if you tell me people are reading less, but they're still getting nourishing type of entertainment or brain activity, whether it was through other mediums of art, right? Media of art, like whether it's theater or movies, but if you're replacing that with gambling, that's where I'm disappointed.
Yeah. Yep. That's short form. It's short form videos. It's little clips, and she talks about the newspaper. So in 1975, about half of 20-somethings said they read the newspaper every day. Today, less than 10%. So now most Americans are getting their news on their phones, their laptops, and 40% say they prefer to watch or listen to online news rather than read it. There's a whole other discussion there about news in general. So we're not going to go down that road, but we're getting data, or we're getting our information from far different sources around, again, 10, 15, 30-second clips versus sitting down and like wrestling with a book, a complex text. I saw a separate study, I don't have it here in front of me, but I saw a separate study that corresponds with this around just our level of cognition, our ability to comprehend has been drastically diminished because of short form video, short form like media that we're consuming.
This is why 2 cents is almost an hour long, guys. We're
exactly exactly right. We're going to turn this into something you have to read. So anyway, it's a long article. It goes on to say it presents some pretty scary figures for me. Being the father of 2 young kids, I read this and I immediately that night was like, kids, we're having reading time. So I wanted making me want to emphasize this even more. But in 2024, in a national test, 35% of high school seniors were quote unquote proficient at skills such as analyzing complex fictional themes and evaluating the effectiveness of an author's argument. Anyway, there's tons of different stats here. It goes on to say that even at the highest levels of education, talks about like Harvard, they interviewed students who talked about reading just being completely useless at this point, and they get frustrated. They think that the professor is like withholding information or gatekeeping information if they're making them read a book. That's at Harvard, and it just made me think: Are we not fully like? Is this shifting so quickly with how we consume information, how our levels of cognition and our ability to comprehend things? Is it shifting so quickly that we're not fully grasping the second order or third order effects of this as society? Not to go too deep at the end of 2 cents, but it makes me think.
Yeah, I think there are two conflicting forces at the same time. Like, the world has become faster. Everything can be done in a much more efficient way, faster way, which puts reading itself at a disadvantage, right? Because now, instead of spending 4 hours reading a couple chapters in a book, I'll just watch a 20-minute YouTube summary of the book and move on with my life, right? There's that efficiency aspect. But on the other hand, the other force is that like writing a book is like literally distilling an essence out of out of a flower, etc. It's so concentrated. It's very high quality and pure in terms of the quality of that content. And unfortunately, because it's so easy to produce content these days, the quality has gone down. So in my mind, how do you balance between these two forces? The need to keep up with the pace of efficiency of this world, but at the same time not jeopardizing the quality of the content that you're consuming. And here's where I don't have an answer.
Yeah, no, it's a good point. This is a bigger discussion. Again, we threw it here at the end, and completely different from most topics that we talk about. I just thought it was interesting. It was personal to us because, again, we both enjoy reading. I think it's a critical part of the formation of society. It talks about like the creation of the printing press in 1440 and how that literally has created societies. So anyway, we won't go any further on this. I just think it's an interesting topic. Maybe a little PSA. Pick up a book. If you haven't read a book for a while, pick up a book and see it. So my focus right now, Rabih, is for the next year, I actually want to focus more on like fictional, like classic literature. I struggle with this because I'm like, am I really getting something out of this? But I'm forcing myself. I'm going to be reading like actual fictional books. You want to do this with me?
I'm going to leave it till my retirement.
No, you're like, I'm too stuck on the studies. I have to, I'm with you. It's tough. Okay. Anything else you want to add, Rabih, on any of this? Okay. A little fun change up there. Well, if you're still listening, we appreciate you. Again, if you're out there, you're thinking you need help with anything regarding your financial planning, investment management, taxes, accounting, we're here to help. dentistadvisors.com. Click on the book free consultation button. For now, Rabih, thanks for being here and sharing your words of wisdom as always. Everyone, thanks for listening. That was our 2 cents. Till next time, take care. Bye-bye.